Here's a number that stops me every time I think about it. Commerce Bancshares has been in the banking business since 1865. Abraham Lincoln was still president. The Civil War had just ended, and 161 years later, this Kansas City bank is still compounding shareholder value, still paying dividends, still run by the same founding family.
And they just reported Q1 2026 results this morning. EPS of 96 cents beating the 94-cent estimate. Net income up 7.6% year over year. This is the kind of bank that makes credit crises look like minor inconveniences.
That's exactly the story today. Commerce Bancshares, ticker CBSH, a Midwest regional bank that doesn't make headlines but quietly builds wealth quarter after quiet quarter. Let's dig in.
Let's do it.
All right, let me set the stage. Commerce Bancshares is the holding company for Commerce Bank, and it operates across three distinct segments. You've got consumer, which is your everyday retail banking, auto loans, mortgages, credit cards. Then commercial, corporate lending, leasing, treasury management for businesses. And then wealth, which is trust and estate planning, discretionary portfolio management, and brokerage services for high net worth clients.
The three-segment model is actually key to understanding why CBSH trades at a premium to many peers. Consumer and commercial generate the net interest income, the spread between what they earn on loans and what they pay on deposits. But wealth management generates fee income that doesn't depend on interest rates at all. It's a natural hedge.
And the footprint is concentrated. They operate 287 plus branches across Missouri, Kansas, Illinois, Oklahoma, and Colorado. These are Midwest markets with lower cost structures than the coasts, good deposit pricing power, loyal commercial relationships. Commerce Bank is often the bank for mid-sized Midwest businesses that don't need the Goldman Sachs of the world.
Founded in 1865 in Kansas City, Missouri, headquartered there still. About 4,600 full-time employees, market cap of roughly $7.5 billion at the current price of around $51 a share.
And here's the acquisition story that's dominating the Q1 picture. CBSH just closed on a bolt-on acquisition that expanded total assets from $32.9 billion to $35.7 billion, a $2.8 billion balance sheet jump in one quarter. Goodwill jumped from $147 million to $254 million. Shares outstanding rose from 137.6 million to 145.9 million. This isn't a transformational deal, but it adds meaningful scale in their existing Midwest markets.
The moat at Commerce Bancshares comes from 161 years of relationship banking, combined with a credit culture that borders on paranoid in the best possible way. Their net charge-off ratio runs consistently below peers through every credit cycle. That's not luck. That's underwriting discipline, baked into every loan committee meeting for 16 decades.
The person at the helm is John W. Kemper, and his story is almost as old as the bank itself. He's the fifth generation of the Kemper family to lead Commerce Bancshares. Joined the bank in 2004 after Princeton and Harvard Business School, worked his way up through commercial banking and technology strategy, became president in 2013, CEO in 2018.
That family ownership dynamic matters a lot for how you interpret CBSH. When your family has been running this bank for 161 years, your incentive structure is completely different from a typical public company CEO. You're not trying to hit a 3-year target for a bonus. You're trying to hand the institution to the 6th generation in better shape than you received it.
Analysts describe Kemper as measured and disciplined, not a flashy dealmaker, not an empire builder. He's modernizing the bank's digital capabilities and expanding selectively. The Q1 acquisition is consistent with that pattern. Small, targeted, synergistic.
His track record through the 2022 rate shock and the 2023 regional bank crisis, when Silicon Valley Bank and Signature collapsed, was notably clean. CBSH didn't have the concentrated uninsured deposit exposures or the long-duration bond portfolio mismatches that doomed those banks. Boring, disciplined banking at its finest.
Lana, walk me through the financials.
Let's start with valuation. CBSH is trading at a trailing PE of about 12.9 times, which is actually modest for this quality level. The forward PE on 2026 estimates of $3.93 comes out to 13 times, and on 2027 at $4.34, it falls to under 12 times. The price-to-book ratio sits at 1.73 times. That's the premium we keep talking about relative to peers, and we'll cover why it's arguably justified when we get to the peer comparison.
And revenue.
Net revenues, that's net interest income plus fee income, came in at $476 million for Q1 2026. That's essentially in line with the $478 million estimate. A very slight miss on revenue, but a beat on the bottom line, where it matters. Earnings per share of 96 cents beat the 94-cent consensus by 2 cents.
Net interest income is the lifeblood metric for a bank. How's that trending?
Positively. We estimate Q1 2026 NII came in around $295 million, up from $269 million a year ago in Q1 2025. That's roughly 9.7% year-over-year growth in the bank's core earnings engine. The net interest margin, what the bank earns on every dollar of earning assets after paying depositors, is running around 3.4%. As interest rates stabilize and the bank's lower-cost funding reprices down from pandemic-era highs, that margin has room to expand. On profitability more broadly, the return on equity was 14.9% for full year 2025, which is genuinely excellent for a regional bank. Return on assets was 1.722%. The efficiency ratio, the share of revenue consumed by non-interest expense, was running around 57% through 2025, though it bumped up in Q1 2026 as acquisition integration costs flowed through. We'll talk about that in the bear case.
Cash flow picture.
The bank generates healthy operating cash flow. We estimate trailing 12-month OCF around $658 million, with free cash flow near $574 million after capital expenditures. For a bank, the more relevant cash generation metric is pre-provision net revenue, PPNR, which strips out the noise of loan loss provisioning. Q1 2026, PPNR was about $185 million. That's the bank's normalized earnings power before credit costs, and it's expanding.
Balance sheet.
Total assets expanded to $35.7 billion with the acquisition close. The bank holds $573 million in cash, $8.6 billion in short-term investments, largely agency securities, and an estimated $19.5 billion in loans. On the liability side, roughly $27 billion in customer deposits fund the vast majority of the balance sheet. Total equity stands at $4.3 billion, giving a tangible book value per share of about $26.92. The current price at $51 implies a PB of 1.73 times.
And credit quality.
Exceptional. CBSH needed virtually zero provision for loan losses in Q1 to 2026, effectively a small reversal. That's a remarkable statement about the quality of the loan portfolio. Net charge-offs running near zero means every dollar of earnings goes directly to the bottom line rather than absorbing losses. Tier 1 capital ratio is estimated around 12.8%, well above regulatory minimums.
What's the financial health verdict?
Overall, Commerce Bancshares' financial health is solid. The bank is well capitalized, virtually debt-free at the holding company level, generating growing NII and maintaining best-in-class credit quality. The only wrinkle is the near-term efficiency ratio pressure from the acquisition integration, but that's a temporary friction on an otherwise very clean story.
What's Wall Street's read on CBSH?
The consensus is squarely hold across the analyst community. KBW maintained market perform in April, Wells Fargo held equal weight in March, Morgan Stanley stayed equal weight in early March. Piper Sandler is neutral, TD Cowen is hold, not a single upgrade or bull call in the recent slate.
So the street respects the quality but isn't pounding the table.
Exactly. The average price target is around $56, implying about 9.6% upside from the current price of $51.11. The range goes from 48 on the low end to 63 on the high end. Analysts appreciate the credit quality and the NII tailwind. They just don't see a near-term catalyst powerful enough to justify a re-rating above 1.7 to 1.8 times book.
And the Q1 2026 earnings reaction?
Modestly positive. EPS of 96 cents beat the 94-cent estimate. Revenue was a slight miss at $476 million against $478 million expected. Net income grew 7.6% year-over-year. The market's reaction should be measured. This is exactly what you'd expect from Commerce Bancshares: consistent, reliable, slightly boring, which for a bank is a compliment.
Let me build the bull case for CBSH. First, NII expansion has real legs. As the recently acquired bank's assets fully reprice at higher market rates and wholesale funding costs continue to normalize, net interest income could trend from the current $295 million per quarter toward $310 to $320 million. That's a meaningful earnings uplift that would push EPS materially above the current $3.93 annual consensus. Second, acquisition synergies. Management expects to extract 15 to 20% cost savings from the acquired bank's expense base as systems and operations are consolidated. That's a reliable playbook for CBSH. They've done bolt-on acquisitions before and integrated them efficiently. Third, the wealth management segment is a durable compounder. As generational wealth transfer accelerates across the Midwest, Commerce Bank's trust and estate services are well positioned to grow AUM without needing favorable interest rates. That fee income is structurally recurring and high margin.
And the bear case, commercial real estate exposure is the number one worry. Like all regional banks, CBSH carries meaningful office and retail CRE balances. A prolonged office vacancy problem, particularly in Kansas City, St. Louis, and Wichita, could eventually pressure the loan book even with historically conservative underwriting. Second, the efficiency ratio deterioration is real. Non-interest expense jumped sharply in Q1 2026, pushing efficiency towards 61%. If integration costs linger longer than expected, the promised synergy story gets pushed out, which means EPS upgrades get pushed out with it. Third, deposit competition continues to intensify. Fintech platforms offering 4 to 5% yields on savings accounts have been pulling at the edges of CBSH's core deposit base. If the Fed cuts rates but competitive deposit pricing remains elevated, the full funding cost decline management is modeling may not materialize on schedule.
Fair exchange, two legitimate stories, and the stock price reflects that ambiguity. Hold consensus, modest upside to target. How does Commerce Bank shares stack up against its peers?
Let's use price to book, since that's the most appropriate valuation lens for banks. CBSH sits at 1.73 times book. Cullen/Frost Bankers in Texas trades at about 2.1 times book, the clear premium in the Midwest and Southwest regional banking group with a best-in-class deposit franchise and zero-blemish credit history. BOK Financial, the Tulsa-based bank with a similar Midwest and Southwest footprint, trades at about 1.59 times book. UMB Financial, which is actually headquartered in Kansas City and competes directly with Commerce, trades at roughly 1.44 times book, cheaper on PB, but carrying some post-merger integration uncertainty of its own.
So CBSH trades between CFR and BOKF on price to book. Is the premium justified?
The case for yes. CBSH's 14.9% ROE is the highest in this peer group. Higher ROE generally means higher sustainable PB. The case for scrutiny, CFR trades at 2.1 times book with a slightly lower ROE of about 12%, and analysts explain that premium as a function of CFR's exceptional loan growth and zero credit losses. CBSH has the credit quality, but not CFR's growth trajectory.
So CBSH is the quality middle ground, better than UMBF, not quite CFR.
That's a fair characterization. Quality regional bank, premium but not excessive valuation, appropriate for a long-term hold in a diversified portfolio. Not a sprint, not a story stock.
What's the options market telling us?
Subdued. CBSH is not a heavily traded options name. It's a smaller regional bank, not a momentum trade. Implied volatility sits at the 42nd percentile, well below what you'd see around a volatile earnings story. The put-to-call ratio is 0.85, mildly cautious but not alarming. The notable open interest is clustered around the $50 puts and $55 calls, essentially bracketing the current price zone. That implies the options market is pricing in a roughly $48 to $57 range over the next 60 days. No large directional bets, no unusual activity. The market sees this stock as a range-bound quality hold.
Which is pretty consistent with the fundamental picture.
Exactly. Options are a sentiment gauge, and sentiment here is nothing exciting, nothing scary. Commerce Bank Shares is doing what Commerce Bank Shares does.
Any insider signals worth noting?
Modest and routine. 2 board members made open market purchases totaling about 5,000 shares over the past 6 months. Small, but directionally positive given the stock is off from its 52-week high of 63.1 times. 3 senior executives executed pre-scheduled 10b5-1 plan sales of about 20,000 shares combined, primarily to cover tax obligations on vesting stock awards. The Kemper family's multi-generational stake remains the dominant insider holding. That's the insider signal that matters most at CBSH, and it's not going anywhere.
What should investors watch going into Q2 2026?
3 things. First, the efficiency ratio trajectory. If Q 2026 brings the efficiency ratio back below 58% as integration costs fade, that's the green light that acquisition synergies are on track. If it stays elevated above 61%, that's a signal to reassess the timeline. Second, net interest margin direction. Watch for management's NIM guidance on the Q1 earnings call. If they guide toward 3.5% NIM or higher for the full year, the NII expansion story has real momentum. A flat or declining NIM guide would temper enthusiasm. Third, commercial real estate credit quality. Watch for any increase in non-accrual loans in the office or retail CRE category. CBSH's credit culture has been bulletproof, but CRE stress is the tail risk that keeps regional bank analysts up at night. First signs of deterioration would show up in the specific mention of reserve builds for those categories.
In the broader macro context,
Interest rate path is everything for a bank. If the Fed cuts rates aggressively, CBSH's floating rate loans reprice down before the fixed rate deposit costs fully normalize, creating a temporary NIM squeeze. If rates stay higher for longer, CBSH continues collecting elevated loan yields with gradually declining funding costs, a very favorable position. The bank has structured its asset-liability profile to perform reasonably in either scenario, but the higher-for-longer outcome is clearly better.
Lana, bring it all together. Commerce Bank shares Q1 2026.
CBSH is exactly what a 161-year-old Midwest bank should be at this moment. Growing net interest income, pristine credit quality, disciplined management, and a fresh acquisition adding scale without disrupting the core franchise. The Q1 beat on EPS against a slight revenue miss is consistent with the bank optimizing profitability even as it absorbs integration costs. The hold consensus makes sense. You're not going to get a massive re-rating here, but you're also not going to get a nasty surprise.
For investors in growth mode, CBSH is probably frustrating. For investors who want consistent compounding, a 2.1% dividend, and management whose family has literally been doing this for 5 generations, it's exactly what you want.
The one metric I'd watch obsessively is NII growth quarter over quarter. If the 9.7% year-over-year NII expansion we're seeing holds into Q2 and Q3, powered by the acquisition and the rate environment, CBSH at 13 times forward earnings starts to look genuinely cheap for the quality level.
Key metric to watch: net interest income growth and efficiency ratio. Those 2 numbers together will tell you whether the acquisition is additive or just expensive. Lana, we always end with a quote that captures the spirit of the company. For a 161-year-old bank run by the same family for 5 generations, I think Warren Buffett said it best. It takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you'll do things differently.
That is Commerce Bank shares in one sentence. They've been building that reputation since 1865, and that's exactly why the Kemper family is still extremely careful about how they deploy capital.
That's going to do it for this episode of Charged Alpha. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.